Hello, what's going on, folks? My name is Chris, and in this video I'm going to go over a trading session that I would say was my best trading session, trading something called FOMC, Federal Open Market Committee, aka USA interest rate announcement, which typically happens on a Wednesday around 2 p.m. Eastern New York time. And then at 2:30 p.m., this guy named Jerome Powell gets on the microphone and starts talking about the US economy. And while all this is happening, the markets are moving a lot. So I've been trading since 2018, and I've been aware of this FOMC thing pretty much since I started trading futures. So I've traded, I think probably at least, at the very minimum, 25 to 30 FOMC events. And I would say that today, May the 1st, 2024, was the first time that I actually felt very relaxed throughout the entire thing and very confident in the trades that I was taking. It wasn't a perfect trading session, but I ended up walking out of the session up on the day a good amount relative to the amount of contracts that I was trading. And I just wanted to make this video going over the session a little bit, sharing with you guys some notes for the session. Because I think that anybody out there who's pretty much new to day trading, maybe futures or stocks, maybe you're learning about trading the FOMC, maybe you've heard some things online about how people trade the FOMC, certain advice that they give. I want to give you my perspective on this. I've made previous videos in the past about FOMC, but this is the newest video. So thank you very much for joining me. If you appreciate my content, my insights, and everything that I'm sharing, let me know with a comment down below, and I'll put a link to my stockbroker, Interactive Brokers. And if you click that link, it will pretty much instantly support my content. So if you do want to click that link, I will appreciate it a lot, and it's pretty much no cost to you. And if you want to open an account with them, I would recommend them as a solid place to hold your money and a very good stockbroker to trade US stocks. So let's get on with it right now. Wednesday, May the 1st, 2024. I want to explain to you the session from start to finish, which includes getting up in the morning. I'll be 100% honest with you guys. I slept in this morning. I'm recording this on the same day. It's May 1st. It's at nighttime now. I slept in today, and I did it purposely because if there's going to be a time where I want to expend my energy, it's probably when there's going to be more volatility in the markets. Now, I trade US Treasury futures primarily. These are the markets that I've traded the most when it comes to futures. When I first started trading futures in late 2019, early 2020, I was trading NASDAQ futures, NASDAQ micros, and I traded those for a couple of years, and then I started transitioning to other markets. In 2021, I transitioned to trading US Treasury futures, and since then, I've pretty much stuck around there, I'll be honest with you, to the point where that's, I would say, my main market, the main markets that I watch. There's going to be another video that may be already out by the time you're watching this, where I'm explaining my one monitor setup of how I arrange my chart books and all that. So definitely go watch that video because it shows how I arrange my charts and my DOMs, but you're also going to see that here in this video, okay? So today I got up late in the morning anticipating, now keep that word in mind, anticipating, because I'm going to use that word a lot in today's video because a lot of trading is anticipating, not predicting. I was anticipating that I was going to save my energy and prepare to trade the FOMC and not trade in the morning. The prior 2 days, Monday and Tuesday, I traded in the morning. However, Wednesday, I did not. I went into Wednesday very relaxed. I had enough time to get up in the morning, move my body, smoke a couple cigs, drink coffee, play guitar, practice some Chet Atkins arrangements, write down my notes on my paper, open my chart books, prepare for the day, go through and play out multiple scenarios of what the market might do when the FOMC announcement happens, you know, a bit of visualization. I think that having time before you sit down and enter that focus state that's required for trading, I think it's good to, you know, be able to at least get the juices flowing in your body a bit. And I had the opportunity to do that today. So now let's talk about the FOMC, and I'm going to go over my screen recording here as I'm narrating this to you. And I want to narrate you multiple points from today's session. So before the FOMC announcement, I had all my chart books open and ready to go. And I actually had multiple chart books open for trading and for analysis before the announcement went through. And I'm primarily a futures trader. These are the markets that I'm most comfortable trading on the Software Sierra chart. So I have chart books open at this point before the announcement takes place for indices, which includes ES, NASDAQ, Russell 2000, and YM. Second chart book would be crude oil. So spot crude oil CFDs, as well as crude oil futures. And the last two chart books were number 3, Canadian dollar, so USD against the CAD futures, and as well as the spot FX coming from FXCM. All this data is provided by Sierra Chart, and I have it on my chart books. And then the last chart book is US Treasury futures. And in that chart book, I have 4 of the US Treasury futures: the 30-year bonds, the 10-year notes, the 5-year notes, and the 2-year notes. And I'm watching all 4 of those at once. So the first thing to note right before the FOMC announcement is that the liquidity on the book gets very, very thin. So that's when you know the market is about to expect some sort of a news announcement. It's about to react to something. Now, I don't know exactly why this happens, but it just happens. Whenever the order book thins up, so normally in treasuries, there's at least 1,000 on average at every single bid and offer, meaning on average there's 1,000 contracts that want to buy at every single price, and on average there's 1,000 that want to sell at every single price. On average, there's a lot of them, right? Before the FOMC, that number might go all the way down to like 50 or 100. So all it would take essentially is someone to come in and buy 50 and 100, and the market will move a lot more than it normally would. That's what happens right before a news announcement, and you can see that right here as the market has basically very little liquidity on the order book right before the FOMC is about to be announced. Okay. The first thing about when the announcement went through that I want to say as a general point is that it moved very, very fast. So just as an example, have a look at this screen recording. It's going absolutely crazy. And if you guys trade these markets, these treasury markets, the tick value in US dollars for these markets is quite high. So for the 10-year, it's about $15.50 for every single tick that it moves. So if it's moving this fast and crazy, like all you could put on a trade and you could lose like $100 in like a millisecond if something goes wrong, if it goes against you, or you can make $100 in a second too if it goes in your favor. But you're really gambling. Like it would be the equivalent to just betting on red or black, because it's really pure gambling at that point. You really just have no idea what it's going to do because it's moving so ultra fast. There's not enough liquidity to contain the price. So that's pretty much how the FOMC started. And I would say it was too volatile for at least the first 10 minutes. This is something that I want to mention, which is the sweet spot. What I think of the sweet spot is an area of volatility where I can get a good read on the market. Too much volatility, the market is too insane. It's not respecting levels, it's overshooting prices. So it's less reliable to trade. I don't have edge trading when that volatility is too extreme. The complete opposite is when there's literally nothing going on. All the traders have gone on vacation, they're gone for the day, whatever, and the markets are just moving on, algos and back and forth. So I find that there was a sweet spot today for a good amount of time. I would say for about an hour, there was a good sweet spot for my trading where I was able to execute the trades that I'm comfortable executing, that I have, in my playbook, in my understanding of the market. So I would say for the first 10 minutes, the market's moving way too freaking fast. And my first trade took place about 14 minutes after the FOMC announcement. And I'll tell you exactly when that was. So these are all the trades I took on FOMC here. I'm going to block out the account numbers. So the first trade was on Canadian dollar futures. So that's the Canadian dollar against the US dollar futures, which trade on the CME. And then the other trades, I had 3 trades on the 5-year T-note or Treasury note futures. And I had 4 trades on 10-year Treasury note futures. And you can see we made it up on the day here. We had a little bit of a drawdown in the middle there, and then we made it back on the last 2 trades. So the trades themselves and the profit and loss, in my opinion, doesn't matter that much. I'm still at a point in my trading where I'm trading 1 to 3 contracts on treasuries, building up my consistency, building up my confidence. And I am at a point now where I'm a lot more solid than I've ever been. Okay. So, don't look at the small numbers and be like, this guy doesn't know what he's talking about, because I truly believe that I have some valuable insights to share for newer traders that are just getting into this. It might save you some time and energy and lessons that you might end up learning on your own just by listening to some of the things that I have to say here. I truly believe that you can benefit from some of the things that I'm saying in this review. Okay. And another reason why I'm reviewing this is because my audio didn't get recorded in my screen recording, so I'm going over each trade individually. Okay. So as the FOMC is playing out here, There was a lot of volatility. It was overshooting prices. I didn't have any good trade setups for the first 10 minutes. You can see I had a long order there on 10-year at 21.50, and I was waiting a while as the volatility contracted about 10 minutes after 2 p.m. I had an order to go long on 10 years, but then I saw it do this. This is something that's unique to the way that I trade. I saw it trade at 22.50, and I actually decided to pull my order at 22 even. Just because this trade here at 21.50 and then reversal reduced the chances for me that I would get a good fill on this order here at 22. So I ended up pulling that order. I also had a short order up at 30.75, and you're going to see that order get filled a little bit later when I wasn't expecting it to get filled. Not long after I pulled that order, I glanced at the Canadian dollar futures, and the chart looked something like this, where if we look closely at this chart right here, you can see there is a daily level right there. Now, I'm not going to go over how these levels are categorized, but what you could see here is that if you look at the low of this 15-minute bar, it bottom ticked that daily level, and now it's trading in the middle of the range. So what I decided to go for in this case is a long trade, anticipating that the market is not going to go back to this price right now. I'm anticipating that it's going to go for highs before it goes back there. So it was a long trade basically. Now, I would say this is not one of my A+ setups. This would have been about probably a B setup. It would kind of be like a get my hands wet, get some skin in the game type of setup, get a feel for the market type of setup. So I put on one contract right over here as I was watching it go back and forth. I put in a bid at 7.45 on the Canadian dollar futures, and I did end up getting filled on that as it came back in. Now, what it did after that is interesting. So it went against me a couple of ticks, which I was fine with because my stop is below 7.15. And this market trades at $5 a tick. So it would have been about a $40 to $50 risk. The market starts going up as I had anticipated. It continues up. And I'm just switching back towards my treasury markets. Now at this moment, I actually realized I was filled on my order on the 5-year. I had a short sale order on the 5-year there at 30.75, which is also a daily level. And you might see that on the chart if I scroll to it in a second here. So I was filled on my short order at 30.75, and I do like how the market moved up into that order. You can see it moved up very quickly into that price, and now it's consolidating around the price. And I'm about to switch over to the chart. There you go. So you see the level right there, 30.75, and you can also see the same level there on the daily chart, okay? So part of my system categorizes this as a daily level of significance. I call it a daily supply-demand zone, a daily supply-demand level, but really it's not the true definition of what you would call supply-demand. It's actually my own definition of how I categorize them, and it's a system that I've developed, okay? So that level is being generated by my system, and the market goes right up to it, and now it's consolidating in this area. Now, I really don't like that it's consolidating here too much. And the other level on the 10-year, the same level would be 25.5. So we have a level of resistance here at 25.5 as well as 30.75. So there's some confluence between the two markets there. That's always good. Something you want to see is when a market flies into a level of support or resistance, it's always good to have support or resistance levels in the correlated markets that the market is also going into. So it's kind of like a multi-instrument support or resistance. So it increases the probability that you're going to get a bounce there or some kind of event there. It may not bounce. It might bounce right off of it, then chop, and then go straight through it, and that can give you a momentum-based trade. That's a different setup, and you'll actually see that if you keep watching the video because one of my other setups is exactly that in this session. So I keep, sticking around in that trade. Meanwhile, my trade on the Canadian dollar is going in my favor. You can see it's almost at my target of 72,800 there. It was just kind of floating in my favor there. The market's going against me a couple of ticks, and I was watching very closely how the order flow was interacting. One thing I noticed is that it went against me 2 ticks and then it quickly sold off again, and I'll let it play for a couple of seconds here. So it sold off after going up a few ticks against me, and I know I'm kind of zooming through this. because I'm reviewing the trades for myself and explaining to you exactly how I was perceiving all this. So I'm looking for about 3-4 ticks on this trade, and I think you'll actually end up seeing me cut this for less than my target because I didn't really like how it was chopping around. And I personally think the longer a trade chops, depending on the circumstances, the more in danger you might be, depending on the trade setup. That's what I mean. So if it's a trade setup that you're expecting to get edge quickly and it's chopping on your entry a lot, that's kind of dangerous. I would rather scratch and re-enter and reposition. But in this case, this is a position where I got a good fill in the area and now it's chopping in the area. So that's also something that I would accept for this particular setup. But now it's giving me mixed signals because it's going back and forth. It's rotated up against me, then it rotated in my favor. Now it's rotating back. If it goes in my favor again, I want to see it continue in my favor relatively quickly. I do not want to see it go in my favor, then come back, because that's going to give me problems. So there you go. There's an example of an order flow event right there where the bids just seemed to disappear. We had a few sellers that came in. The market dropped like 4 ticks in practically a second. And I nearly got filled there, but not quite. No cigar. So I'm looking at how it's trading here at 30.25, and I'm pretty sure I got out right here. I think I moved my order to 30.25 right here. As I saw, it was just not doing anything, and we'll have a look at exactly what I did here. We'll let it play out. Yep, so I moved my order to join the bid at 30.25, and I did end up getting filled on that bid. Was that the right move? I'm not so sure. Now, meanwhile, I ended up cutting my long here at 72.85. It would have went to target if I just let it go to target. But there was something that happened here that I really didn't like what it did. It came 1 tick shy of 800 and then started pulling back. And I was like, I really don't like that. And I really didn't want to risk this trade coming all the way back. So I just got out, best I could. I've had it happen to me multiple times where a market will go 1 tick shy of my target. 1 tick shy of a high, potentially. Like if I'm targeting a high or a tick above the high, sometimes the market will come like a couple of ticks short of that and then immediately start pulling back. And that could be unlucky. It's also part of the nature of how markets operate. Depending on your trade and how you're managing it, sometimes I'll decide to just cut it. I just wanted to cut it and take the money off the table because this was a trade, sort of a get your feet wet type of trade, as I told you guys earlier. It wasn't one that I was willing to hold out and ride out because, we're in FOMC. Things happen quickly. There's pumps and dumps, and I would prefer to scalp rather than stick around trades too long, because the longer you stick around in FOMC, in my opinion, the easier it is that you get burned, the higher chance you get burned. You know what I mean? So I got out of my trade at 30.25. I'm flat at this point on both markets, and now we'll go on to the next trades. Now, one thing I do want to know is that after the FOMC announcement, after 2 p.m., as I noticed that only some of the markets had a pretty big reaction, I actually closed off some of the chart books that I wasn't using, like crude oil. I closed off all my crude chart books because crude for me wasn't really next to any good levels that I thought were worth trading. I didn't really like how it was trading on the day. I was watching it a bit earlier. And I just started watching for setups on bonds and Canadian dollar futures primarily. So the next 2 trades were around 236 and 255 on the 5-year. And by the way, all the trades you're about to see now are all going to be short trades. The only long trade was that one on the Canadian dollar futures. We're going to see 2 short trades on 5-year notes right here. Actually, this one was just a quick scalp, and I actually don't even think it's worth going over it. But you can see the market dumped super hard and fast right there on the entire Treasury market. It just dumped right back into the range, and it bounced right around the support level, a 15-minute support level of 28.25 to 28.75. One thing else that I saw was that it traded up to 30.75, which was my daily level, and 25.50, which is the equivalent level in the 10-year. It went up there, flew up to 30.75 and completed it and immediately rejected. That's a setup that I'll take quite frequently for a scalp. if the market completes right on my level and I see some sellers come in this case and offer it over, a lot of times I will anticipate a short trade right here. And you can see in this case, I put my offer in right there. I would say probably I wasn't fast enough. If we go back a little bit further, let's examine how fast that actually happened. And there was another occurrence of this trade that I actually missed later in the session. So watch how it trades up here. 30.75, yeah, you would have been so lucky to have gotten filled at 30.5. You would have had to been some sort of an algo. Like actually, now that I see that, I could probably write an algo that says if the market goes to 30.75 and it's offered at 30.5, place the offer at 30.5. I don't think my algo would have been that much faster than I was here. Maybe about 500 milliseconds faster or so. And I don't think it would have gotten filled, to be honest with you. So anyways, I ended up getting filled here at 30.25. And I was just looking for a little scalp on that. And basically the out on this is if it starts going bid at 30.75, you get out immediately and you take your quick little loss or whatever it was. But what you're expecting is for it to kind of stay here and you're front running it to stay under 30.75. 2 ticks under, you're not getting that much edge. So I realized I didn't get that much edge on this, so I had to sacrifice a bit of profits, and I actually ended up moving my profit target up and only taking a tick profit on this as I saw that it was chopping here. You see I put my target right there and I ended up just getting filled right there at 30 even. And I don't know if I would have gotten, say, 29.75 or 29.5, but as you can see already, that's too long. I would have been happy to be out of that right now at this point. You can see it's going 30.75 and then it goes against me. I would have definitely been out of that trade. The way that trade played out, because the volatility was so high in this moment, I would say it wasn't that good to be a bread and butter type of trade, but you will see that trade play out again here in the session. And you'll see what I mean when I call it a bread and butter type of trade. Yeah, so let's fast forward to the next 2 trades here, which were 2 losses that I took on 10-year notes at 239 and 240. Okay, so let's look at these ones now. Now, these ones are very important because this is an example of me cutting a loss, which is something that all traders have to know how to do. If you can't cut a loss, you're going to be in big trouble trading during an FOMC event. Big fucking trouble. I'm sorry to tell you, but you need to be able to cut losses sometimes for prices that are bad. Like fucking take the loss, bro. That's why I don't like having P&L up on my screen, and that's why I trade relatively small contracts, because you can absolutely end up in situations where the market rips your face off, and this is one of those scenarios. So I had an order to sell short here. And let's examine exactly what happened. So I was looking at my charts and you can see the markets are going up and we're trading near the high of the session. So 27.50, 29. We're also trading into 24s and 25s near the high of the session in the US Treasury markets. So we fly up to 29 on the 10-year. 29 is the level I just mentioned. Okay, we fly up to 29 and we're complete at 29. I immediately go short at 28.5. I'm looking at that. I see 29. I immediately place an order to sell. I'm looking at 29 and I'm seeing them hit it. And they're trying to trade 29s there. We're at the edge of a range as well. And we're right at a supply zone. And I decide that I think I want to hit it. So as soon as it went offer, I placed my offer and I basically joined the offer. And then it goes bid again. And now what happens from here is important. So keep your ears open. Keep your eyes and your ears open, okay? So it does go in my favor a tick. I'm only looking for a couple of ticks here, but then this happens, okay? It went bid very, very quickly after pulling back to 27.50, and that's something that is really not that good. I really didn't want to see that. And if we look very briefly at the charts, 27.50 right there is the lower end of this range. So you have 29 on the high end. We top tick 29. I'm front running that because we had a complete auction right there. Now it pulls back quickly to 27.50, which is pretty much where I would have been wanting to get out if I wanted to take a quick scalp from 29 being a complete auction. And what we see is a complete at 27.50 and an immediate reversal up. The market immediately bids up, the offers pull away, and it trades at 29 and it goes bid at 29. At this point, I know I'm screwed. And you can see, look how quickly I moved my limit order to join the bid at 29. I would say I was on point on this session, guys. I'm bid at 29 to get the hell out of this shit. And I knew I was on the wrong side at this point. At this moment, I knew I was on the freaking wrong side. If you want to play that back again, let's watch it another time. As soon as it trades those 31 contracts at that price of 27.50, and I did have my limit order at the correct price. It trades 31 contracts, reverses trades on the offer at 28.5, goes bid 28.5. They buy 29 and it goes bid 29 and it trades 29.50. Ouch. That's no longer the scalp that I want it to be in, my friends. I'm bidding to get out. Now let's watch what I do next. I hit the ask and got out. That is exactly what I wanted to do in that moment. I do not want to be sticking around that type of trade, and it turned out that that was the right decision. Okay, my trade was no longer valid. I got out. I knew the time frame of the trade was going to be probably very short. It showed me something I didn't want to see, which was a complete at 27.50 and a reversal off of that, and that is my signal to cut that shit fast. Turned out the thing ripped up like 4 ticks in a second after that. So I would have been heavily offside staying short at 28.5 if I would have stuck around that bitch. Easily a day loser right there. Okay. And this is how FOMC can screw you over bad if you're not on point with your setups. Okay. The next trade on the 10-year was also a loss. It was another short trade here. And what we saw here was the market moved up and it's pulling back from a high that it had made. We traded up to 3 on the 5-year. We traded up to evens on the 10-year. And you're going to see me look back at the chart here in a moment. On my historical charts here on the 5-year, we have some resistance levels that are coming into play, and the market's shooting right into these levels. We have also 114 and 30 here on the 30-year, and as high as 108 and a half on the 10-year. So the market's shooting up at this point, and it ends up shooting up to evens on a complete auction. And I'm not exactly sure why I wanted to go short here, to be honest with you. So it's going back up. It's trading 31.50. And for whatever reason, I think I wanted to go short. So I put an offer up there at 31.50. And I think I ended up getting filled there. And we'll see that here in a moment. So I ended up getting filled there at 31.50, and it immediately goes against me. And I think it stops me out at $1 right there. This is an example of a trade where, looking back on it, I didn't actually see that much that was working in the favor of this particular trade. So I ended up getting blown out there for a 3-tick loss on the 10-year. And like I said, that trade going short at 30.5, there wasn't really much going for it. So that may have just been a revenge trade. I'll be honest with you. I'm not so sure. Now, what comes next is the interesting part. As you can see, the market is moving straight up still. Now, this time we actually have some levels up here. So we have over here 15-minute untested supply zones on the 10-year, meaning that based on the way my system creates those levels have not been tested since they've been created. So that makes them good, actually. It makes them have high confluence. And the market is shooting up into these levels. So we have 2.5, 3.5, and 4.5, 3 levels right in sequence like that. We also have a couple levels here in the 2-year and a couple levels in the 30-year, 115.7 and 115.10. And the market's shooting up into these levels, and you're going to see me start placing offers here. So as high as 4.5, and you can see me starting to place some offers right here as it traded up to 3 and then pulled back. Now, I just want to also say that at no moment during this up move did my system present any long opportunities. For example, if it would have came back down and traded, say, 4 on the bid and 0.5 on the bid and reverse off of that, that could have been a long setup right there. But it didn't do that. It was just kind of chopping and then continuing higher. And actually, it did move down to 4 on the 5-year. That's one, but that's not enough confluence. I would have to see it happen on multiple of the correlations at once. Like, I want to see levels get tested on multiple symbols. So now I've got 3 offers in. I get filled here at 3.5. You're going to see me get filled as it's moving up. I'm filled at 3.5. I'm filled at 4. I'm short 2 contracts. And what I do want to see here is the market just fall back in quickly. As it trades up into this area that I consider resistance, I want to see it fall back in fast. So I didn't get filled on 4-5. I put in one contract to cover quickly because, you know, we're doing a bit of money management, I would say, at this point. Again, it's discretionary. I think that depending on how much you're up on the day and depending on how much you're in the session, how deep you are in the session, I think it's important to be able to make judgments based on money management. If you're slightly down on the day or flat on the day and you're halfway through the session, you may have to cover some faster for profit to kind of, you know, be in a better situation money management wise in the session, you know what I mean? Rather than always trying to let everything ride and not taking any money off the table. That can get you into trouble sometimes depending on how deep you are in the session. So you can see I took one off right there, and I think that was an okay decision to do. And I'm pretty sure I pulled out my third offer at this point. And if I got filled on all three, I definitely would have wanted to take off one quickly like that, as it's going in my favor. But yeah, I ended up just getting out at 2 right there. I originally had my bid at 1/2, and then I moved it up to 2 as it was just chopping on 2, and I saw it go off and then go bid and go offer. And the way it moved in my favor so fast, 3 ticks in the money, I'll take that. You know, I'd rather take that than sit on that, you know. So the market does end up coming back to 3/2. And then I think it does actually end up selling off from that price soon after. But that was the trade. And you can see how fast it happened. And you can examine some of the chop that happened afterwards. So there's our 2 short entries and there's our 2 covers right there, 2/2 and 2. Okay. Now here's a long that I thought was interesting. Going long at 4s. Wanted to take a long here, a quick long, as it completed at 2/2 like that, which would have been the bottom end of that range, which was generated from supply demand zones historical in the 15-minute time frame, completes at 2/2, and I'm seeing the way it's trading here, and you can see I'm hovering over the bid, and you can see it's going bid, and I ended up placing a bid right here, you can see, and I didn't get filled. I'm 300 in the queue at this point, and they just keep going bid. But I wanted to get long for some momentum there, and I didn't end up getting it. So I'm sitting pretty on the session at this point, so I'm able to take more shots, and there's more setups playing out. Like that was a setup right there. That long right there off the complete off of 2/2, and then it's continuing on the upside. That's a setup. For me, that's a setup. Did not end up getting filled. I ended up pulling it, and then it just chopped after that, and I think I was just patient. So now we're 2:49 on the session here, and I'm going to look at exactly when the next trade was. We have 2 more trades. We have one more short trade on the 5-year, and we have one more short trade on the 30-year. So let's examine these 2 trades that happened. So 2:55 p.m. I'm switching between my chart books. I'm looking at what's going on. Overall, we still have a decent amount of volatility. I had a long on the 5-year, and I ended up pulling it, I'm pretty sure. So around 2:51, I placed an order to go long in the 10-year again, assuming that 2.5 would hold. So I have an algo that I've written in Sierra chart that what it does is it places a limit order when the price you put the algo at is bid or is offer. So in that case, I put an algo saying sell limit at 2.5 if 2.5 goes offer. Only if 2.5 is offer, sell limit at 2.5. So basically what I was anticipating here is go long at 3.5. My stop protective is a little bit lower, like probably 2 or 1.5. But really, I want to be getting out at 2.5 if it's going against me, because I don't want to be long if it's going offer at 2.5. So that's an example of setting up a trade where I'm anticipating to get out at a better price than where my stop would actually be, because it would be too dangerous to put a stop down at 2.5 because you can get a quick sweep. It'll stop you out in reverse. That can happen. So I prefer to put the algo there, which would only put my order to get out of my trade if it's going offer at 2.5. And yes, there is a chance that I can still get trapped, but it's a higher probability that I can get out for a slightly better loss, a 2-tick loss, rather than getting stopped out on a sweep, you know, or getting a much worse price exit, you know. So that's an example of managing your downside. And I'll explain more about that algo later, because you'll see an entry using that algo here in a second. So I ended up pulling that order as it chopped and nothing happened. and a few minutes later we will see an entry here on the 5-year. So looks like the market's shooting up again, and it shoots up very quickly around 2:54, 2:55 p.m. It has a complete auction at 875. 875 is a price that is valid for my system, and I think I should show that on the chart before, but I'm not sure if I did. 875 was a valid price. It was a level on the 5-year. You're just not seeing that, but I was shorting, anticipating that 875 would stay offered, and you can see a lot of contracts are trading right there at 8.5. It went complete, and then it slams down when the offers come in, and then bang, we made like 3 ticks actually. But still, for me, that's a bread and butter type of trade. And I know you're not seeing the charts that shows the level, but I know from memory right now that 875 was a level. It was one of those 15-minute supply demand. You can see it right here, right there. Daily, 875. You saw that? So it moved up to 875, completed 875, and then I sold 850. It actually ended up going bid at 875 very briefly, which is bad because I want to see it complete at 875 in reverse. So it actually went bid so briefly, but then it reversed anyways. So the trade ended up working. Sometimes it needs a few seconds. And these things are not perfect. Just because it completes doesn't mean it's going to reverse. It's just something that I like to see. And I want to make a quick note of this, is that the treasury markets are very efficient normally. When the FOMC started at 2 p.m., they were very inefficient. If you really want to see treasuries being inefficient and overshooting prices like there's no tomorrow, watch May 1st, 2024 right at 2 p.m. because it was so inefficient. The most inefficient treasury market I've ever seen. And then it slowly became more and more efficient. And I would say the more you're entering that area of where the markets are becoming more efficient, the more likely you're going to see things like top ticks and bottom ticks of these pivots, and the market reverses exactly as soon as it completes those prices. You know what I mean? So we'll fast forward now to the last trade of the session, which was a momentum trade. Basically what happened after this is the market started going up and down, and it was fading down in a very weird way that was unattractive for me. I really wasn't interested in how this was trading at this point. It's after 3 p.m. So as we're approaching the end of the session, I'm becoming more cautious. I know that I've traded already. The meat of the session is over. From 2 to 3 p.m., I would say contained most of the good volatility, the good opportunities, the trades that are here and gone fast, like the easy money trades, basically is what I'm trying to describe to you. They're most probably gone, and now we're going more into the trades that you have to carefully plan out. You may have to be a little bit more patient with them. There may be a little bit more chop on your entry because we're approaching the end of the session. There could be more weird events because remember, 3 p.m. is the close of the treasury markets. So there's all kinds of orders coming in. So this is right after the close of the treasury markets. And the market is kind of fading downwards. And overall, like I said, I'm not liking what I'm seeing. So you're starting to see a bit of a move down at this point. And now we'll look at my charts very briefly here in a second. I'm just going to fast forward. So for about 10 minutes, 15 minutes, I was doing pretty much nothing. And the market is fading its way down. And then only around 3:11, I put in an algo at the price of 29 to sell at 29 if it goes offer at 29. And I'll explain to you a few reasons why I did that. So one reason is the market is fading downwards. We have a lot of reclaim on the downside. Reclaim basically refers to these levels that I have categorized. Some of them are from larger time frames. If we're reclaiming them on the downside, there's a chance that we can get some momentum continuation on the downside in this scenario. So what I was anticipating here is you can see 107.29 on the 10-year. What we did was the market slammed down. It completed at 29, meaning it only traded on the bid at 29, and then it reversed up and then started chopping for a few ticks. And for me, what that did was present a scalp opportunity to go short if we go offered at 29, and the target would have been basically 27.50, because you can see these two levels are adjacent from one another. They're very close. So I'm playing on a bit of downside reclaim here in the Treasury markets. So I'll fast forward the video. So you can see here's where it completed at that price of 29. 358 contracts traded on the bid, and then it reversed very quickly. And now we're a few minutes after that. And now I'm going to fast forward until we see some action here. So what you're going to see is the market basically chopping here for a while, and we're trading on the ask. There's a lot of ask volume going through, a lot of buying that I was seeing here at 30 and 30.50. You're seeing thousands go in on the offer, and they're just taking those offers. They're buying and buying and buying. And then what we end up seeing is the bids end up just pulling out. So there's a big offer that comes in here. I don't think they ended up trading. Yeah, they did trade here, 30.50. So they keep trading on the offer, and then eventually what you see is the bids pull. The problem is I didn't actually get that on recording, unfortunately. Basically what happened was the bids pulled after they traded all that ask volume, and I got short at 29. You can see here's my entry. It was right here, right around 517. And as I got short at 29, it stayed offer at 29. I was lucky to be filled actually, but my algo got me filled. As soon as there was an offer at 29, I joined the offer trying to get a good Q position. And I ended up getting that contract. The market soon after sold off about a tick or two. It came back and back ticked at 29 for 11 contracts, and then soon after the bids disappeared and we're trading bid. This 2400 here, they slammed the bid and it immediately went down, and I got filled on my bid at 27.50 to get out of the last trade. Okay, so those are all the trades right there. Now what I'm going to do is go over my last few notes here that I want to share with you guys regarding this trading session, because I think some of these notes can help you. Okay, now if you guys are wondering why most of the trades were short trades and not long trades, I think pretty much all of that was shown already in the video. I explained that the setups that are in my system, they weren't present for going long, and they were present for going short. So that's why I ended up being more on the short side than on the long side. There were some moments in the session where I had bids to go long, but those bids were either not filled, or because of how the price was trading, I had ended up pulling those bids because I wasn't confident that I would end up getting a good price. The very last trade of the day showcases the sell limit went off for a client-side order type, which is a custom order type that I wrote in Sierra Chart. It's not available anywhere, but maybe one day I'll release it as a custom study or something. I think it's very efficient for trading treasuries. For other markets that are more spready, probably it's not as useful. But I still think it's good to be able to join an offer when it goes offer, or join a bid when it goes bid at that price. You understand what I mean? So as soon as someone bids for it, you get right behind them. That's the concept of it. Okay. Another algo that I wrote, which is when there's about 25% of the average order size at a price, you can either hit the bid or hit the ask to take whatever's left and anticipate that it's going to continue going. Anticipate. A lot of trading is anticipating, guys, rather than predicting. And especially when the markets are moving that fast, you're anticipating rather than predicting. Because if you're going to sit there and wait for things to happen, you're going to miss all the moves. So this session for me proves that experience is key. This is the first FOMC session that I actually felt very relaxed throughout the entire session. I felt very focused, and I've traded the FOMC multiple times in the past, and I've always had very mixed results. There were trades that did well, trades where I gave it all back. Now, there was a situation in this session where I almost gave it all back on that one trade, where if I would have stayed short or wasn't able to cut my short trade on the 10-year, I could have got easily run over. Would have given back easily about 2 or 3 more ticks of profit because I wasn't quick enough to cut it. So FOMC is the type of event, and I would say not just FOMC, anytime the market is very volatile, you have to be more disciplined, a lot more. You have to be really like stone cold, like if the trade's not working, get out and reposition. And that's part of the beauty of being a scalper and understanding how to scalp, is it gives you that flexibility and that confidence to be able to cut the trade and re-enter if you have to. It's sort of shifting in and out of being a scalper and not. That's at least how I sort of think of it, because there's some moments where I want to let the trade chop and play out. There's some situations where, depending on how the market approached the order, I'm expecting to be in the money fast. And if it chops too long, I want to be out of it. So it's a bit of a feel thing, and it's very discretionary. I felt very neutral throughout the entire session. I wasn't really excited or, hyped up or getting mad. The only time where I think maybe I was experiencing a tad bit of tilt was when I took that first loss on ZN, and it resulted in the next trade being a bit of a revenge trade. And then the third trade, where you saw me put in 3 offers, you could actually make the argument and say I was revenge trading a little bit, because I normally don't put in 3 offers on ZN. And it was after 2 losing trades, so that was a moment where it was probably a bit on tilt. The good thing was it was going into an area where there was multiple factors of support to the trade, where we had, those multiple untested 15-minute supply zones, and it flew right into that area. So I would say, yes, I was a bit on tilt, but also it was a high probability trade to at least get a tick or 2 in my favor. So if I were to get filled on all 3 contracts, I would probably be able to get at least 1 off before it just chops and reverses. You understand what I mean? So money management. So I wrote there were multiple things working in favor of that trade, including the velocity, the price action approaching the area, the fact that we were deeper into the session and volatility is more likely to contract rather than expand. This is actually a big note that I would say to new traders right here. A lot of traders, when they first get into it, you're thinking it's time to trade. We have to take the next trade. You're only as good as your next trade. But you also have to consider the market is constantly in a state of either volatility expansion or volatility contraction. And normally what happens is when the session starts, we have volatility. All the traders are there, they're fresh and focused in the morning, and then slowly that's going to fade. So typically the default behavior is volatility contraction after an open or after top of the hour. So we have this event where volatility is expanded. Now we're approaching the end of the event. Remember, it's towards 3 p.m. That's the moment where I took that short trade on the ZN. So I would say volatility is more likely to contract than expand, which means that if the market's flying right into a price, it's either going to stay there and chop, or it's going to fly right into it, reverse, give us a couple ticks in our favor, and then chop. And that's pretty much what it did. And there is a situation where it could fly into the area, chop, and then continue right away too. And of course, we want to get out of the trade fast if that's happening, as you saw me cut one of those short trades. And, I wrote multiple levels of confluence on the correlated markets, because as it was flying into that 4-5 and 3-5, there was also some levels on the 30 and the 5 right around that same area. So multiple levels of confluence, basically. Okay. Now, the last thing I want to say here is a few notes regarding reviewing trades, and also regarding my setup and listening to the actual announcement. I'll be honest with you, I didn't listen to a single word that came out of Jerome Powell's mouth throughout the whole session. I didn't turn it on. I probably didn't even have a browser open throughout the whole thing. Once the FOMC started, I was locked in to the price action, locked into my system, to my levels, to how I operate. I was locked into that. I was all tabbing between the charts and the DOM. So I have my charts, my levels, the price action. I all tabbed to the DOM. How is it trading? All back to the charts. Where's our next level? Where are we approaching? Did we bottom tick this level? Did we top tick this? How long have we been trading here? So I'm going back and forth between my charts and my DOM. And I'm not listening to a single word of the actual press conference of the FOMC, because it doesn't apply to my system. I'm trading pure technicals here. And even if Jerome Powell were to say something, I will not be able to react faster than these algos from JP Morgan and Citibank will. So, they're going to get to it faster. So I may as well just watch what they do and follow what they do, and rather than trying to anticipate what people are going to react to what Jerome Powell is saying. So I personally don't have any edge listening to the actual press conference of the FOMC. Okay. The last couple notes I want to say here is on the topic of reviewing trades. I typically do not review my trades super deeply, to the point where I'm over analyzing every single aspect of the order flow and every single little price and chop before the trade occurs and after it occurred, because I honestly think that it's not really necessary to review all those little things. What I think is necessary to review is the context of how the trade played out. where it happened in the session, how the price was approaching my order, what it did throughout the trade, how I managed the trade as it was playing out is very important. And overall, my performance, analyzing aspects of my performance in the session is more important than hyper analyzing little elements of the price action and order flow, and if I reacted to an order flow event fast enough. And there are some circumstances where that is important, but overall it's lower on the spectrum of importance compared to the other things I mentioned, like my overall state during the session of, am I on tilt? How am I feeling? Am I trading neutral? Am I trading the right size? Am I executing the setups as they come in, or am I hesitating? How good is the volatility? And is the volatility likely to contract or not? And is my read on the volatility good right now? So those are the things that I'm paying attention to more, which is more related to my overall performance. I would say my overall read on the market is more important. And then another reason why I reviewed these particular trades is because I didn't have any sound recorded on my recording. So I wanted to give myself something to review afterwards. And I guess this will end up on YouTube. So if you enjoyed this video, guys, let me know. Thank you for watching, and I'll see you in the next one. Cheers.